You've been lied to. Every finance guru, every YouTube influencer, every glossy magazine article, they all push the same narrative: buy and hold, diversify. Index funds. It is the only way. Like it is the universal truth of investing. Like there has never been a better strategy in the history of the stock market. They are wrong, and they are hiding something from you. Something that was common knowledge in the 1970s. A rule that made average retail investors fortunes while the institutions looked the other way. Today, I'm going to show you exactly what that rule is, with real numbers, real historical data, and real market history that Wall Street does not want you to know. Because the truth about this forgotten strategy, it changes everything you thought you knew about building wealth. Stay until the end, because the return projection we reveal at the 8-minute mark, it shocked even me. Welcome back to our channel, the channel where we cut through the noise and give you the real story on the strategies everyone is too afraid to talk about. If you are new here, smash that subscribe button right now, because you do not want to miss what is coming. Today, we are going head-to-head with history. The 1970s stock rule versus modern portfolio theory. Two philosophies. One is the foundation of every retirement account in America. The other is the forgotten gem that quietly outperformed everything. We are talking origins, returns, volatility, risk management, market psychology, and the one category where this old-school rule absolutely dominates modern thinking. Let us get into it. Let us start where every great financial debate should start. At the beginning, the 1970s. A decade of stagflation, oil crises, and a stock market that went absolutely nowhere for 10 straight years. The Dow Jones Industrial Average in 1966 was around 1,000. In 1982, it was still around 1,000. Imagine that. An entire generation of investors lost a decade of growth. But here is the thing. Not everyone lost. In fact, some investors made fortunes during this period. And they did it using a rule that has been scrubbed from modern finance textbooks. It is called the 10-for-1 rule. Or more accurately, the concept that you should only buy a stock when it splits 10 for 1. Wait, you are thinking, that sounds insane. Stock splits do not create value. It is just a cosmetic change. And you are right, it is cosmetic. But that is not the point. The point is what the split represents. In the 1970s, a 10-for-1 stock split was a signal. A signal that a company had grown so much, so fast, that its share price had become inaccessible to the average retail investor. Look at the companies that executed these splits. Walmart did a 10-for-1 split multiple times. Intel did it. Microsoft did it in the 1980s. The rule was simple. When a great company does a 10-for-1 split, buy it and hold it. The split itself meant the company was expanding, earnings were growing, and management was confident enough to multiply the shares outstanding. It was a stamp of approval. And the returns. The investors who followed this rule in the 1970s and 1980s saw gains that make modern index funds look like pocket change. Now, let us talk about what actually matters. The numbers, the returns. From 1970 to 2000, the S&P 500 delivered an average annual return of approximately 12.9%. That is excellent, by any standard. But the stocks that executed 10-for-1 splits, they outperformed the market dramatically. Studies from that era, studies that have been buried and forgotten, showed that stocks that executed 10-for-1 splits generated average annual returns of 18% to 22% over the following decade. Some individual stocks, like Walmart, delivered returns that were multiples of that. Let that sink in. We are talking about outperformance of 6% to 9% annually, compounded over a decade. A $10,000 investment in the S&P 500 in 1970 would have grown to roughly $340,000 by 2000. Not bad. A $10,000 investment in stocks that had executed 10-for-1 splits, with reinvested dividends, it would have grown to over $1.4 million. That is not even close. Now, you might be thinking, why do I not hear about this strategy today? Why is every financial advisor telling me to buy index funds and ignore stock splits? That is exactly the question Wall Street does not want you to ask. Here is where it gets really interesting and really uncomfortable. In the 1970s, retail investors, ordinary people, were using this strategy. They were buying individual stocks. They were researching companies. They were building wealth independently. Wall Street hated that. Because if retail investors are buying and holding individual stocks, they are not paying fees. They are not trading constantly. They are not generating commissions. So what did the institutions do? They changed the narrative. They started promoting index funds. They started pushing the idea that you cannot beat the market. They created a culture of passive investing. And it worked. Today, trillions of dollars are parked in index funds. The average investor has been convinced that picking individual stocks is gambling, that it is too risky, that you should just buy the whole market and accept whatever returns come your way. But here is the truth that nobody in the finance industry wants to say out loud. Index funds deliver average returns. That is the point. You are getting average returns. You are not getting wealthy. You are just keeping up. The 10-for-1 rule, and strategies like it, were designed to identify outlier stocks, the exceptional companies, the ones that were growing faster than the market average, the ones that delivered extraordinary returns. Wall Street does not want you to know this, because if you are buying outlier stocks, you are not buying their products. You are not generating their fees. Okay, I promised you a stat at the 8-minute mark that would shock you. Here it is. When researchers at the University of Chicago studied stock split performance, they did not just look at returns. They looked at the outcomes, the actual wealth created for investors. And here is what the data actually shows. Stocks that executed 10-for-1 splits in the 1970s and 1980s did not just outperform the market for 1 year. They outperformed for an average of 15 years. Listen to that again. The rule was not a short-term trading strategy. It was a long-term investment philosophy. The investors who bought these stocks and held them for 15 years saw generational wealth created. The data does not point to a market inefficiency. It points to a structural advantage. The companies that were growing fast enough to require a 10-for-1 split were the same companies that would dominate their industries for decades. And that is the truth the financial content world does not want to say out loud. Because it is easier to tell people to buy index funds than to tell them, do your homework, pick individual stocks, build your wealth. These are not retirement vehicles. These are wealth-building opportunities, and they deserve the attention of investors who are willing to do the work. I said it, someone had to. So, after everything, origins, returns, psychology, institutional resistance, and the wealth created, who wins? Here is the honest answer. It depends entirely on you. If you want a safe, predictable, low-maintenance way to grow your retirement account slowly over 40 years, the index fund is your strategy. Full stop. It is the easy button. It requires no research and no stress. If you are willing to do the work, if you are willing to look for the companies that are growing faster than the market, if you are willing to buy and hold through volatility, if you want to build extraordinary wealth rather than average wealth, the 1970s stock rule is unmatched. On safety and simplicity, index funds, not even close. On potential returns and wealth creation, the 1970s rule, not even close. Both strategies are valid, both deserve respect, and both deserve investors who understand exactly what they are getting into. That is the truth about the 1970s stock rule, the truth nobody else is saying. If this video gave you something to think about, do me a favor and hit that like button right now. It takes 1 second, and it helps this channel more than you know. Subscribe if you have not already. We drop market deep dives, investing strategies, and financial history every single week. And comment below, Team Index Fund or Team 1970s Rule? I read every single one. Next week, we are going somewhere even more controversial. You do not want to miss it.